Oh my gosh. All right. Hey, how about that? Can you hear me now? That's horrible. Oh my gosh. Chris Forbes, thank you so much. I'm glad I checked my comments. That really sucks. I didn't have my microphone on. Man, rookie mistake. Rookie error. Okay, so here's the deal. Let me go through this again. Let's start over. I will edit that out on the replay and start from scratch here. Let's do this again. Can everybody hear me now? Can I get a comment? Can I get an amen? Somebody can hear me? Hopefully I didn't lose everybody in the process. But yeah, total rookie mistake. My bad. I had my microphone off. So, all right, let's do this again. I'm hoping that works. I'm gonna wait till I see a comment and then I will restart if somebody wants to give a comment and let me know what's happening. All right, perfect. Sorry about that, Chris. Thank you for the heads up. And let's just do this again. And I'll edit the front part off there. So glad I checked that out. So cool, perfect. I will rock that. Let me get this going. Let's start this over here. So I'm gonna start that from scratch, and I'm gonna try to give everybody insight into this. So here's what I'm doing. Actually, I'm gonna kind of go from here. I'll kind of give the overview of what I'm talking about here because you didn't hear the intro. So ultimately, here's the point of this video. I've been having a lot of people reach out to me in my comments of the videos talking to me about the fact that, listen, I'm comfortable with Index Universal Life. I like the upside potential. I like the downside protection. I'm a really conservative agent. I try to run it and I'm comfortable running it at the 6.3% range. I am confident in the fact that when I do a minimum death benefit, maximum cash value, that these policies are gonna be great and I can put my head on my pillow at night and feel really good about what I'm doing for clients. And that's all fine and good. My question back to every agent recently in the comments that likes to go there on me is, are you aware of all the moving parts in an IUL? Are you aware of how companies are even able to offer the downside protection and the upside potential? How they come up with what their cap rates are, how they come up with, the participation rates, how they come up with all these different moving parts. And the answer for every agent to this point in time, there's probably been a dozen of them that have actually engaged and been willing to kind of take me on a little bit in the comments. The answer has always been no. And what the best that I've gotten back from them is, well, essentially what they do is they take a portion of the premium and they take that portion of the premium, say 5%, and they buy a call option with it, and they put the rest of it in a fixed market, and therefore that gives you kind of downside protection, and you have the upside potential based on the call option, and that makes it sound awesome, right? And so the reality is it's not that clean. And if it were that clean, it'd be better. It'd be better, more advantageous for the insured, and the policyholder. But the bottom line is you can't actually do it that way, because if you do it that way, then you're participating in a market. They can't take your money directly and put it into an index or buy a call option with it, because then it becomes more of a variable hybrid policy. What happens is they take your money and they put it all into the insurance general fund, right? And you're never really participating in the market. I'm just gonna check for comments here. All right, rock and roll, we're good to go. So you're never really participating in the index. You are using call options, but I wanna explain how they get the call options, how do they decide how much money they're gonna buy the call options, how they do that, how that impacts the cap rates, and ultimately what they're doing, which is kind of shady, to go around all the forces that are driving their rates down. And they're using a bit of a shell game to create more flexibility for the insurance company. It's actually ultimately going to bite the consumers in the butt, I think. So I'm excited to get into this a little bit. So let's go here. So let me repeat what I did before, and we'll do this again. All right. So I'm gonna erase this 2010 here for a second because it's not relevant for the conversation. I'm gonna do this over again. So here's how they work. So what happens is every insurance company has an expected performance that they know is gonna happen in their general account, right? So here's the deal. These insurance companies have been doing this for 110, 120, 170 years in some cases. There's no better risk management. There's no better industry for risk management and getting guaranteed returns than insurance companies is what they do. I mean, that is the nature of what they do. And so every company in the world right now is getting anywhere in their general account between a 3.5% and a 4.5% return, right? That's just the reality. So let's just say for argument's sake, they're getting a 4% return. Let's split the gap, right? So if they're getting 4%, what does that mean? So here's what happens. If you have $10,000 in cash value in an IUL, so in this example, what it would be like a $14,000 premium or something like that, and 10,000 of it would be going towards a cash value. I'm just giving round numbers. So just know this isn't a $10,000 premium. This is 10,000 of cash value in the policy, right? So this isn't even 100% effective because out of every dollar that you put into the policy, like every insurance, whole life insurance included, you are going to have cost of insurance, admin charges, that kind of stuff going on. And so it's just important to know this is just the cash value component right there. So you know that if the insurance company knows that if you're giving them $10,000 cash value, what they have is they know their insurance, their general account is gonna earn this 4% on a fixed basis. So what do they know? They know that 4% is gonna kick off $400, right? $400 in guaranteed returns. So when I talk simplistically about how do they offer the 0% downside and the upside potential of the cap rate, it's all based on that $400. Because what they do is they say, okay, you're giving us this $10,000. What we're gonna do is we're gonna make sure that your $10,000 is safe. But what we're doing is we're saying we know that your $10,000 deposit is gonna create this $400 result. So what we're doing is we're taking this $400 result and we're buying a call option, right? So that call option is, say, the S&P 500, right? So when they're in the call option, when they buy a S&P 500 call option, $400 worth on your $10,000. What that means is if the market goes up, right, then you're going to participate in the S&P 500 and you're going to get up to a cap rate. So if let's say they give a cap rate of 10%, you'll participate in the market up to 10%. And if it doesn't do well, then you lose the $400 and your $10,000 is safe, right? If the market does negative or flat, you basically lose that $400 and your $10,000 is safe. But here's the bottom line. It's not even that clean, because now what I want to do is I want to go backwards here. Let's take a look back in history and time. This is important for everybody to understand, because I know I've been talking a lot about interest rates and the fact that a reducing interest rate environment mean cap rates have to come down, which is true because it shows the general funds are coming down. They're performing worse. That impacts dividend rates for whole life policies. It impacts interest rates or cap rates for IULs. But the bottom line is, now let's go here. Let's go to 2010 and let's look at the environment, and let's look at back then. Insurance companies were earning about 7% on average in the general account, right? So what does that do? Let's take a look at the same $10,000 assumption. So the $10,000 assumption on the general account here would be, we know that if all things being equal, we know it's going to create a $700 return, or on the year. So we're going to take the same concept and we're going to say we're going to buy $700 of call options, right? And when we buy $700 of call options back in 2010, what is that? That's what is that? How much more is that here? I want to figure this out. I want to do the math because I threw a number out the other day and I want to make sure I have it. So it's right. So it's basically 43% more money, or 43% more call options. But it actually gets worse than that, because here's the deal. From 2010, so it buys you 43% less in call options. So that alone is going to reduce the cap rates, right? That's why the cap rates get reduced. It's not because this went down to 4%. It's because this actually buys you less call options now. In 2010, it's now 400, or 2021, it's now 400 instead of the 700, right? So, but here's the deal. Back in 2010, the S&P 500, this was a newer strategy. There were less players in the game. In fact, one of the challenges The more players that come into the index universal life game, most people don't realize this, but they've created a market that has increased the charges on their own stuff. So S&P 500 index, the Dow Jones Industrial Index, this Russell 2000 index, all of these indexes have gotten so expensive for call options because there's so much more money going into them, because there's index universal life and day traders are investing in these indexes, so it's a much more competitive environment, right? And so not only since 2010 have you been able to buy less call options because you have less money, because the performance in the general account has shrunk, but here's the bottom line. Call options are more expensive now, right? So if call options are more expensive now, you have 43% less money buying the call options, and because they're more expensive, you can actually buy less call options. They're not as efficient. Each dollar you're buying in call options is less efficient. So it's actually worse than the scenario. There's more variables at play than just the fixed interest market, if that makes any sense. So I'm gonna go over here and I wanna just check and see if there are any questions. All right, no questions yet, so that's okay. So ultimately, let me go back. So ultimately, here's the deal. We're, from my perspective, I look at it like this and I say, okay, let's look at the variables. And if we know that that's the case and we want to look at what's been happening here, we have, instead of $700, we have $400 in this example, and that $400 isn't even going to be as efficient with the call options that it's going to buy. And so therefore, if a cap rate back then was 16%, they're able to buy 43% less call options, right? So I'm going to go here. I'm going to go 16%. Watch this. And let's just look at the math, guys. It's crazy, because when I say that the cap rates that they're offering at the beginning of these and why they have to be sold, or why the cap rates have to come down and why they create new products, is because of this, is because of the fact that, listen, it's just common sense. It's math. So if you go 16% cap rate times 0.57, which is a 43, that's a 9.12 cap rate. That's just on the general fund, right? That's just on the fact that we're at 4%. That's 43% decrease from 7%, right? Now, if you increase the cost of the actual options, that 9.12% has to come down on the cap rate. And that's just even where we are right now, not accounting for the fact that if we stay in this longer term environment, there's going to be more pressure and they're going to have to reduce them, which the pricing just continues. And with technology, with more day traders, with the fact that more people are buying options and it's way more advanced than it was back in 2010, the more people that get into that game, the more expensive the game becomes. That's just the reality. I mean, I think GameStop kind of showed a lot of people that the way that these options tradings work, and it just gets more expensive the more people you have playing into the game. And so here's the bottom line. Back in 2010, there were a fraction of the amount of IUL carriers that there are now. I mean, look at World Financial Group. Nationwide is a new IUL carrier. They didn't even carry IUL. They didn't even have an IUL product in 2010. They're an example of being new to the game, right? So like, that's just kind of something to take into consideration for this, is that when you do that, that level of competition has actually created a challenge. Now, here's where it gets super shady to me. And I'm just going to check comments one more time and see what's going on. All right, so no comments. So what I'm going to do is I want to open this up and I want to bring it here and I talk about this a little bit. Let's go here. So here's the bottom line. This is where it gets really shady to me, and where I'm going to do tomorrow morning, by the way. Watch out for this, because I'm launching a video where I'm doing a full review on this flagship product from World Financial Group. And so this is just an example of what the problem is here to me. Like, these companies, what happens is, because of the nature of the competition that comes into the equation, and consumers are not aware of this. It's really, to me, it's mind-blowing. But the S&P 500, you can see the cap rates are well, the 30-year historical average. I'm not sure what the cap rate is on that, but it only allows you to illustrate 5.96%, right? That's what it illustrates at, and then 5.96 there. The maximum you're permitted to show actually is 6.18. But here's the bottom line. Those are the two kind of core, the Dow and the S&P, those are the core indexes that all these IULs were using a decade ago. But because of what I was talking about in the competition and the cost of options going up, that made it so that was really impacting the efficiency and the cost effectiveness of buying the options, and it was hurting their cap rates so bad. So what did they have to do? They had to go out and they had to get involved in these other crazy weird indexes, and they make it look really awesome. And they've created these features that say, oh look, the cap rate with the S&P 500 is 9.5%. with a 4% guarantee cap rate. That looks really good on the S&P 500, and that's fine. But the bottom line is the reason it's lower here is because of the cost. But now they go down to the JP Morgan Mosaic 2, both the 1 year and the 2 year. They have uncapped, right? Look at this, uncapped with participation rates of 135 and 190% now. It's crazy to me. They illustrated at 6.32%, and they say there's a 30-year historical average of 10.52%. So here's the thing. I went here and I looked at this and I said, okay, let's look at the details, because the devil's in the details, right? And check this out. And if you look at this, hold on, I got to do this again. So if you look here, 30-year historical average, I want to show this again, 7.69 and 10.52. Do you see any disclaimers on this page? Any asterisks? Anything of that nature? No, I don't. I don't either. Okay, so when you go here, I looked up actually the index, the Mosaic 2 index, and I went into here and showed that basically the basket constituent from February 7th, 2012 to December 27th, 2016 labeled as back-tested performance from December 28th, 2016 through March 31st, 2021 labeled as actual in the chart above. So here's the bottom line. Anything before December 28th, 2016, and you can go look this index up, just copy or just go in here, type in this index into Google, it'll pull up the index for you. That's all you have to do. And you'll notice that index didn't even exist until 2016. And I didn't find that for certain that it's tied directly to this product or to nationwide products, but this is what insurance companies are doing now. Because of the fact that the S&P 500 call options are so expensive, companies like Nationwide are going to companies like JP Morgan, banking and investment institutions, and they're saying, hey, let's create an index that we can, make look really good and offer all these different things. We'll put it out there, and we want to tie our, and you gotta make it a real index, but we're gonna tie our index universal life and our index annuity performance to this index, and it's gonna make it look, think about it, this hasn't existed since before 2016. And look at this, they have a 30-year historical average. It's really easy to pick up a 10.52% 30-year historical average if I don't have to go back and actually have real performance. If I had the ability to go through the S&P or go through any basket of funds that I wanted to and just pick the performers out for 30 years and say, okay, this is what I want to do because I want it to look really good on a sheet of paper and back test it, like how they're able to even put this on here without an asterisk, like results are not real, like that, it's completely mind-blowing to me that they're able to do that, and people are buying this hook, line, sinker. And I don't trust this as far as I could throw it, because if Nationwide and JP Morgan are in this, that means JP Morgan, if this is exclusive to Nationwide, that means JP Morgan has the ability to manipulate, no different than the S&P. The S&P 500 is just, it's stable, it's predictable, it's got a good reputation for being the most stable index in the world because of the way that it's run, right? But the JP Morgan Mosaic 2, they get to pick and choose the baskets of investments that they want on a year-to-year basis. And if they're in bed with Nationwide on this, then that's not a good thing. And then here's another thing. This is the Zebra 2-1, right? So this index was developed with Roger Ibbotson and Zebra Capital and is exclusively available with the Nationwide New Heights Fixed Index Annuities partnership with UBS and Annexus. And so that's, the index products with Nationwide, it is what it is. It's mind-blowing to me that they're able to do this and they're able to get away with it. And here's the deal, what they're doing is they're reducing their cap rates, and they're accomplishing all this stuff simply by, or they're not reducing their cap rates. They're trying to make up for the fact that the costs the reduction in interest rate environment, the increase in option costs, which has driven down cap rates like crazy and will drive it down more. What they're doing is they're creating indexes that are exclusive to their product that they can control, that are brand new indexes. They're creating this fictitious 30-year back test to make it seem like it's really good. They're allowing people to have these uncapped rates with everything. And at the end of the day, all they're doing is they're creating these fictitious indexes that, you know, they're in bed with the people that created them. And so I don't know about you, but with everything else that's going on, I don't trust that as far as I could throw it. So I'm not sure if that makes sense to everybody, if anybody has any questions about that. But to me, that is like, it just goes to show there's a huge lack of transparency. And that is just a fraction of the issue that I have with Index Universal Life. I mean, but that is one of the things that I needed to get out there and that I needed people to understand, is that there are these moving parts. It's not that I hate Index Universal Life. I hate the lack of education by the agents that are selling it and going out there and selling it like it's this great product, you know, and that it's, you know, that it has all this stuff and there's very little risk. And not that there's no risk, but a lot of people think there's very little risk. But the reality is there's a lot of risk coming down the line. And, you know, listen, Index Universal Life was created in 1998, I think it was, 97 or 98. And it was created as a solution to Universal Life being a failure. Universal Life came out in the early 80s, and at the end of the day, when Universal Life was created, interest rates were super high, so they illustrated phenomenally, right? Because the fixed markets were great. As the interest rate environment kept shrinking, they needed to come up with a solution where they can make a better product. And what they did is they created the indexing strategy, and that worked really well. And at the beginning, when options were cheaper because there wasn't, you know, the technology and there wasn't as many players in the game, the companies at that point in time, it did really well. The interest rate environment kept shrinking, cost of options kept going up, it made the market more competitive, people, you know, the companies started struggling. Index Universal Life is going to come on the same struggle and come up to the same fork in the road, the same problems that Universal Life came into. And at the end of the day, it's just a financial experiment. All these people that are trying to say that it's this amazing solution, listen, just go look around. Go look around. I mean, it hasn't been out for more than 23 years. That's it. So we don't have the history. We don't have the knowledge. What I know is the history from IUL is that it's just done nothing but get worse and worse and worse and worse and worse over the past 2 decades. That's what I know. So there's nothing that shows me with the indications of the market. There's nothing that shows me with the indications of option pricing. There's nothing that shows me in the case of the economy, in the fixed interest rate environment, in the fixed economy. Like, there's nothing showing me that leads me to have any level of confidence in Index Universal Life. So that's one of the big reasons that I'm a big believer you should never try to invest in a life insurance contract. That's, people think, those that listen to my videos and think that I'm comparing whole life to Index Universal Life as like the investment component, it's not an investment component. I don't believe your insurance policy should be an investment. I believe your investment or your insurance policy should be a savings vehicle. There's a big difference. Investments can lose money, savings can't lose money. So if you handle it right, the variable in a whole life policy, the only variable is you. If you save money there, that money is gonna beat a bank account. And I'm a big believer that everybody needs safe, liquid, usable money in case of opportunity and emergency, you know, to be able to protect their financial, you know, fortress, right? So that you need to have that. And so a whole life policy is good for that. Your risk, yes, you need to take risk to become wealthy. Risk should come outside of the policy. Your business, your business, crypto, real estate, you know, buying and flipping cars. I know the people that do that, doing hard money lending. There are some amazing strategies that I'm going to be talking about here coming up in the near future on different types of strategies you can use. You can use your whole life policy as leverage for that you're actually not legally allowed to use your IUL as leverage for because the IULs are not as safe. And so what happens is, with an IUL, you're putting your money at risk. So I'm not comparing whole life to IUL ever. I'm comparing IUL to a different type of investment, right? But the bottom line is, with an IUL, I just showed you a bunch of the risks and the options and you know, as far as the cap rates and all that stuff and what expectations are. And in my belief, in my mind, like when you take the insurance costs and you lump it into there and you take in the variables in an IUL contract that could be moved by the insurance company that are not in the insured's favor, they're not in the policyholder's favor, they're in the insurance company's favor, because that's all IULs were created for, is to be a better solution to universal life. And universal life was created as a solution to take the risk that is on the insurance company for a whole life contract and put that risk on the insured, the policyholder. And so the bottom line from my belief is that, you know, your IUL contract, if you want to invest, if you want to risk money and that's your deal, go invest in something. Put it in a Roth IRA. If you make too much money for that, figure out alternatives. I suggest, I coach people to put money into a whole life contract, get a guaranteed return, build that as a financial fortress, a tier 1 asset, just like banks, just like corporations use, and then leverage that money to invest in other things. And that's where you want to get your rate of return. If you're trying to chase rate of return inside of an insurance policy, I promise you it's going to come back to bite you in the butt. So that's it. So I just want to say ahead of time, for anybody who was here live that stuck through this whole thing, I appreciate you being here. My audio problem at the very beginning, Chris Forbes, thank you for bringing that to my attention. Appreciate it much. I can't believe I made that mistake. So total rookie move. But for everybody that's watching the replay, I'll clip that part off. And if you have any questions, any comments, go ahead and leave them in the comment below. If you haven't already, hit the like button, because I think this is so important. I want to get this out to as many people as possible. I'm really going deep on this, man. So at this point, the IUL is screwed from the explanation you give, and someone is stuck in it unless they want to forfeit a bunch of money if the policy is early on. Yeah, so if you have an IUL right now and you're in the surrender period, that's the other part. And this is, IULs have super long, typically about a decade long, 10-year surrender period, right? So with a 10-year surrender period, that means your money is locked up in that IUL policy until you're 10, right? Like you're always gonna have a portion of your money locked up. So if you're in an IUL and you're in year 3 or 2, especially, you're gonna have some significant surrender charges probably, especially if you've put any significant amount of money in there. That could be pretty bad, right? I mean, it's gross. I actually was looking at some stuff the other day and it was pretty disgusting. And so what I would suggest is just get with a licensed agent. If you don't have anybody, I can connect you with somebody. I can't give individualized advice because I'm not licensed anymore and I'm not going down that rabbit hole. But I'm happy to have a generalized conversation with anybody if you're worried about your setup. I'm not going to give you specific advice, but I can, after our generalized conversation, I can connect you with an agent that I think can help you. You know, and if you are, here's the deal. If you are an IUL person and you do want to, you know, if you want to take a risk inside of IUL, even though it's way outside of what I would consider tolerance wise for risk, I do have a couple IUL people that are the only people I trust. I mean, I have one guy who's like just a genius. He knows more about Index Universal Life than anybody else that I can think of on the face of the earth. And you know, if you wanted to write a policy, he would write a policy for you and actually coach you through the real expectations, not all this garbage pie in the sky 6.32% stuff that these World Financial Group and PHP and, you know, professional, was it Freedom Equity Group and all these other companies are going to sell you, you know, because it's just crazy. So yeah, I mean, at this point in time, I'm really worried about Index Universal Life. I like whole life simply because it's about expectation management. I'm not trying to get my returns in my whole life policy. I'm trying to use my whole life policy as a financial fortress that's going to get a 25 to 30 times return compared to what my savings account would get. I'm a big believer people should save before they invest. So I'm going to save money and then I'm going to wait for the stock market to crash. I'm going to wait for all these problems to crash, for the real estate market to crash. And then when that happens, I'm going to be sitting on a pile of liquid accessible money that I control, that I can go in and then take risk and invest in real estate or a business or buy assets when the rest of the world is making poor financial decisions based on need because they have bad financial structure. When the economy tanks, which it's going to, I'm going to be sitting there with money waiting to take advantage of the opportunity. Warren Buffett always said, make money when there's blood in the streets. That's kind of a sad way to think. I never want to wish any ill will on anybody. But at the end of the day, the people who are prepared are the people who are going to benefit. So, you know, that's it. I think it's important to understand. So, anyway, I hope that all made sense. If you haven't already, please hit that subscribe button, click the bell. That way you get notified every single time I launch a new video. Hit that like button, and you know what? If you could share this out, it's super powerful. I think, you know, 99% of IUL agents don't understand this, and I do believe that most Index Universal Life agents are doing this because they want to do the right thing. They sell because they bought, you know, into the story. They've drank the Kool-Aid, so to speak, and they believe it. And believe me, I was there once upon a time too. I get it. I bought the story. I drank the Kool-Aid. And what I want to tell you is I didn't understand this. And as soon as I understood this, it started giving me pause. And there are so many components to this that just make IUL super risky. So my hope is that I'm not trying to insult or bash Index Universal Life just for the sake of it. I'm trying to educate people in a way that your companies are not willing to educate you because they feel like if you knew it, you wouldn't sell it. And obviously we know the agenda there. So anyway, I hope you have a blessed, inspirational day, and this all helped, made sense, added value into your life. And if it did, please feel free to share it, and we'll talk to you in the next video. See you guys.